Hugh, always good to see you. Your language on the case for a harder or hard landing is extremely surgical, very carefully worded. The case for a bear market and hard landing remains strong and cannot be easily dismissed. The case for a bear market and hard landing cannot be ignored. These are careful phrasings. Is this, though, your base case, that there is likely to be a hard landing, or just that we can't ignore the possibility?
Well, yeah, I think, Tyler, it's the possibility. I think what I'm calling it is, it's a very close call. In other words, I think the case for a hard landing or a recession certainly has to be not dismissed, has to be taken seriously. I think the odds still favor, although I'm saying this with my fingers crossed, is that we're going to have a soft landing, or the economy is going to continue to expand, but at a slow pace. Keep in mind, it is now currently slowing. We had 1.3% growth rate in the first quarter. That's not particularly impressive. And as we start the second quarter, when I look at the month of April, I can calculate what I think is real gross domestic product for this simply the month of April, and we're talking about 0.9%. So the economy is slowing. Consumer spending is slowing. So you have to take seriously the possibility of a hard landing, although, believe me, it's a very close call, and I'd like to cross my fingers and hope for that soft landing.
So maybe it's like the Senate's majority right now. Maybe it's just a little bit tipping one way or another. Let me follow up with one question. You know, the old cliche is that history doesn't repeat, but it sure can rhyme. If you look back at the history of bull markets, you point out that this bull market that we're in right now is roughly of the duration and magnitude of most bull markets, which would suggest that we may be in the 8th or 9th inning of it.
Yes, exactly. It's if you take the duration as well as the magnitude of this bull market starting in March of 2020, which is, everybody dates it differently, but I think that's when you should date it. You take the duration of this one, 51 months, the average is 47 months since 1890, and the magnitude of this one is currently roughly the same as the magnitude of all the bull markets, the average magnitude since 1890, which was 143%. That's where we are now, which just simply says, take seriously the possibility that this one could end. We could have a bear market. It could be accompanied by a recession. And when you look, as Mike has suggested, at the performance of the markets, particularly utilities, which performed great, very strong performance in the current quarter. The message there is you've got to really take it seriously, or there's a possibility that we could have that so-called bear market and recession. Again, fingers crossed, hopefully it's a soft landing.
Hugh, are you happy to stay in potentially less lucrative parts of the market until we know that answer? Because some people were anticipating a bear market for the last year or two now.
I know, and I've been among those that have expected it to come, especially when you look at things like leading economic indicators, which have been down now 25 or 26 months. That's not good news. And when you take a look at of course, the yield curve, which we've been talking about continuously for about a year and a half now, those are signs that you might be headed for trouble in the economy. So I think, I got to take it seriously. So to some extent, and I don't like to be buying things like utilities and staples and safe sectors of the market, but quite frankly, given the performance of the market, given the case for a hard landing, you have to have some of that in your portfolio, along with, quite frankly, communication services, which has been performing well. And, of course, technology is performing spectacularly well. But believe me, when you see utilities and staples perform like that, get some defense into your portfolio just in case.